So you want to get into crypto trading, and you're looking for the single best strategy that's going to make you a millionaire overnight. Well, I hate to be the one to break it to you, but it just doesn't exist. The truth is, the best crypto trading strategy is completely personal. It's not a one-size-fits-all t-shirt, it's more like a custom-tailored suit. It has to fit you perfectly. What works for a high-risk day trader with a six-figure bankroll is going to be disastrous for a beginner who's just dipping their toes in the water with a few $100s. Your personal risk tolerance, the amount of capital you're willing to invest and potentially lose, and your level of experience are the three pillars that will support whatever strategy you choose. Ignore them, and the whole thing comes crashing down. Before you even think about placing your first trade, we need to talk about the non-negotiables. Think of this as your pre-flight checklist. First, risk management. You absolutely need to know how much you're willing to lose on any single trade and stick to it. Second, education. You wouldn't try to fly a plane without lessons, so don't try to trade crypto without understanding the market. Third, discipline. Emotions are your worst enemy in trading. A solid plan and the discipline to follow it are your best defense. And finally, staying updated. The crypto world moves at lightning speed, and you have to keep up. It's not just about watching prices, it's about understanding the technology, the news, and the market sentiment. For all the beginners watching this, my advice is simple: start small. Seriously, I mean it. There is absolutely no reason to go all in from day one. You're here to learn, and the market will charge you a tuition fee. It's up to you how expensive that fee is. A great way to learn without paying a single dollar in tuition is through paper trading. This means you trade with fake money on a real platform, allowing you to test your strategies, get a feel for the market's volatility, and make all your rookie mistakes without losing any real capital. Once you've proven to yourself that you can be consistently profitable on paper, then you can consider moving on to trading with small, real amounts. So with that said, let's break down the 7 main strategies so you can find your perfect match. Alright, let's start with the OG strategy, the one that's become a meme, a mantra, and a way of life for many in the crypto space. HODLing. This stands for hold on for dear life, and it's exactly what it sounds like. You buy a cryptocurrency like Bitcoin or Ethereum, and you just hold it. You don't panic sell when the market dips 20%. You don't get tempted to take profits when it pumps 30%. You're in it for the long haul. We're talking months or, more likely, years. The fundamental belief here is that despite the wild short-term volatility, the long-term value of your chosen assets will significantly increase over time. This is less about trading and more about investing. The biggest pro of HODLing is that it's incredibly low stress compared to other strategies. You don't need to be glued to your screen watching every price tick. You make your purchase, secure your crypto in a safe wallet, preferably a hardware wallet, by the way, and then you can pretty much forget about it. However, this requires 2 very important things: immense patience and unshakable conviction. It's easy to say you'll HODL when things are going up, but can you stomach watching your portfolio drop by 50% or more during a bear market and not sell? That's the real test. You need to have done your research and truly believe in the long-term potential of the project to resist the urge to panic sell at the bottom. Next up is a strategy that's a perfect companion to HODLing and is fantastic for beginners: dollar cost averaging, or DCA. This is probably the most sensible and disciplined way to build a long-term position in any asset, crypto included. The concept is incredibly simple. Instead of trying to time the market and invest a huge lump sum at what you hope is the bottom, you invest a smaller, fixed amount of money at regular intervals. For example, you might decide to buy $50 worth of Bitcoin every single Friday, regardless of the price. Whether Bitcoin is at 70,000 or 50,000, you buy your $50 worth. The magic of DCA is that it removes emotion from the investment process and reduces the impact of volatility. When the price is high, your fixed dollar amount buys you fewer coins. When the price is low, that same dollar amount buys you more coins. Over time, this averages out your purchase price, meaning you're less likely to have bought everything at a market peak. It's a set-it-and-forget-it method that automates discipline. Most major exchanges even allow you to set up recurring buys, so you literally don't have to do anything. This is ideal for long-term investors who believe in an asset's future but don't want the stress of trying to perfectly time their entry. Now we're moving from long-term investing into the realm of active trading with our third strategy, swing trading. If hodling is like planting a tree and waiting for it to grow, swing trading is like surfing. You're not trying to catch every tiny ripple, but you're also not waiting for the tide to come in over several years. Instead, you're looking to catch and ride the significant swings or waves in the market that happen over a period of a few days to a few weeks. The goal is to capture a chunk of a potential price move, either up or down, and then get out and wait for the next opportunity. This strategy requires a much more hands-on approach than hodling or DCA. You can't just buy and forget about it. Swing traders rely heavily on technical analysis, which is the study of price charts and market statistics. You'll be looking at things like support and resistance levels, moving averages, and various indicators to identify potential entry and exit points. It requires a decent time commitment, as you'll need to be scanning charts regularly, but you don't have to be chained to your desk all day. It's a good middle ground for those who want to be more active than a hodler but don't want the intensity of day trading. Alright, let's turn up the intensity. Welcome to the world of day trading. This is exactly what it sounds like. You open and close all of your trading positions within a single day. A day trader's goal is to profit from small intraday price movements. They might buy Bitcoin in the morning because they see a bullish pattern forming and then sell it a few hours later for a 1 or 2% profit. They go to bed flat, meaning they hold no open positions overnight, protecting them from any crazy price moves that might happen while they're asleep. This is a high-octane, high-risk, and high-reward strategy. Make no mistake, this is not for the faint of heart or the inexperienced. Day trading requires an immense amount of skill, focus, and capital. You need a deep understanding of technical analysis, market structure, and order flow. You're making rapid decisions under pressure, and you have to be comfortable with taking small, frequent losses. In fact, successful day traders often have a win rate of only 50 to 60%, but their winning trades are larger than their losing trades. It's a full-time job that requires you to be at your desk, analyzing the market for hours on end. For most people, the stress and the steep learning curve make this an incredibly difficult way to make money. If you thought day trading was intense, let me introduce you to its hyperactive cousin, scalping. This is honestly the most fast-paced trading strategy that exists. Scalpers aren't looking to make just a few trades a day. They're actually looking to make dozens or even hundreds. They aim to skim tiny profits off a massive number of trades. We're talking about profits that can be as small as a fraction of a percent. The idea is that all these tiny little wins will add up to a significant amount by the end of the day. A scalper might be in and out of a trade in a matter of minutes or even seconds. This strategy demands absolute, undivided attention and, honestly, lightning-fast execution. Every single second counts. Because the profit margins are so razor-thin, things like exchange fees and network latency can be the difference between a winning and a losing trade. You have to be trading on a high-liquidity market and often need direct market access for the fastest possible order execution. Frankly, scalping is almost impossible to do manually on a consistent basis. This is where trading bots and automation come in. Many successful scalpers are actually programmers who build algorithms to execute their strategies for them because a computer can react far faster than any human ever could. Now for a completely different type of strategy that isn't about predicting which way the market will go. This is arbitrage. At its core, arbitrage is the practice of taking advantage of a price difference between two or more markets. In the crypto world, this means a coin like Ethereum might be trading for $3,500 on one exchange, like Coinbase, but at the exact same moment, It might be trading for $3,505 on another exchange like Binance. An arbitrager would simultaneously buy ETH on Coinbase and sell it on Binance to pocket that $5 difference, minus fees, for a near risk-free profit. Sounds easy, right? Well, not exactly. The challenge is that these price discrepancies or spreads are usually very small and they don't last long. We're talking seconds. To be successful, you need two things. First, you need incredibly fast execution. Just like with scalping, this is often the domain of automated trading bots that can monitor prices across dozens of exchanges and execute trades instantly when an opportunity arises. Second, you need significant capital. To make a meaningful profit from a 0.1% price difference, you need to be trading with a large amount of money. You also need to have that capital pre-positioned on multiple exchanges, ready to go at a moment's notice. Our final strategy is one of the most classic and widely used approaches in any market, trend trading, or trend following. The philosophy here is simple. The trend is your friend. Instead of trying to predict tops and bottoms, a trend trader identifies an established market trend, either an uptrend or a downtrend, and rides it for as long as it lasts. They aren't trying to be the first one in or the last one out. They're honestly happy to jump on board after a trend has clearly established itself and ride it for the majority of the move, getting out when it shows signs of reversing. To do this, trend traders use a variety of technical indicators to help them confirm the trend and identify entry and exit signals. Moving averages are a key tool. For example, a trader might enter a long position when the 50-day moving average crosses above the 200-day moving average, a classic golden cross signal. They would then hold that position until the trend shows signs of breaking down, perhaps when the price closes below a key moving average. This strategy can be applied to any time frame, from long-term weekly charts to shorter-term daily charts, and it removes the need to guess or predict. You're simply reacting to what the market is already doing. So, there you have it. 7 different crypto trading strategies, each with its own unique profile of risk, reward, and required commitment. We've covered everything from the passive, long-term approach of HODLing to the hyperactive, split-second decisions of scalping. As we said at the very beginning, there is no single best strategy. The best strategy is the one that you personally can understand, feel comfortable with, and execute consistently. It has to align with your financial goals, your tolerance for risk, and the amount of time and energy you're willing to dedicate to it. A strategy that keeps you up at night with stress is the wrong strategy for you, no matter how profitable it might be for someone else. My final piece of advice is to walk before you run. If you are just starting out, there is absolutely no shame in sticking to the lower risk, lower stress end of the spectrum. Start with HODLing a small amount in a project you truly believe in. Get comfortable with the market's volatility. Practice dollar-cost averaging to build your position over time in a disciplined way. These methods will help you build a solid foundation and gain invaluable experience without exposing you to catastrophic risk. They allow you to learn about the market's rhythm and your own emotional responses to price swings. Once you have a solid footing and have proven to yourself that you can stick to a plan, then you can begin to explore the more active strategies. Maybe you start paper trading a swing trading strategy on the side. Maybe you dedicate a very small, speculative portion of your portfolio to trying out day trading. The key is to build up your skills and confidence gradually. Remember, trading is a marathon, not a sprint. Your goal isn't to get rich quick. It's to stay in the game long enough to become consistently profitable. So do your research, manage your risk, find the strategy that fits you, and start small.